I'm Ramin Taloui, the Distinguished Policy Fellow here at SIEPR. And it's my pleasure to introduce Darrell Duffie, who will be moderating our first panel on private credit. Darrell is the Adams Distinguished Professor of Management at Stanford's Graduate School of Business and a senior fellow here at SIEPR. He's been on the finance faculty at Stanford since receiving his PhD from Stanford in 1984. So more than 4 decades at Stanford. His recent Brookings paper explains how the Fed can downsize its balance sheet without blowing up the economy. So it's worthwhile reading. When he's not solving these kind of thorny problems of policy like this, you can find Darrell out on the coast riding his bike. Those of us who know Darrell would add that he's one of the kindest and most collegial colleagues one could have, validating everything you might have been led to believe about Canadians. Darrell?
Thanks, Ramin. You and Neil have assembled tremendous panels of speakers today on 3 major topics at the leading edge of research and technology, finance and technology. And they intersect. I mean, for example, Governor Cook just explained to us how AI is affecting the market for private credit. And that's the topic of this particular panel of leading experts, who I'm going to introduce in a moment. So from the benefit of their knowledge, we're going to get a better understanding of questions like, how effective is private credit relative to traditional bank lending? How resilient is private credit to stresses, for example, coming from AI? Governor Cook mentioned a recent spate of redemptions. I'm sure that we're going to hear about those. And by the way, we're going to learn a lot from you as well. So start thinking about the questions you want to ask while we have these experts here. And when severe stress does come into private credit markets, what does that look like? How does it play out? So from my immediate left, we have Nina Boyarchenko, financial research advisor in the research group at the Federal Reserve Bank of New York. Her research focuses on financial stability, credit cycles, and fixed income markets. To her immediate left is Jared Ellias. Jared is professor of law at Harvard Law School. His research focuses on corporate bankruptcy and debt markets. His most recent work is on private credit and on globalization of the bankruptcy system. And to my far left is Tarek Hamid. Tarek runs the U.S. Credit Research and Strategy team at JP Morgan. His team covers investment grade and leveraged finance credit issuers, borrowers, and markets across both cash and derivative products. So with that, I'm going to call first on Jared. We'll have discussion across the panel, and then we'll rely on you to interrogate our panel.
Okay, so I thought I would briefly open our discussion just by sharing a little bit about what I've learned in trying to answer an important question, which is, where did private credit come from? How did we get this industry that currently manages about $2 trillion in assets that has become an integral part of the corporate credit market? And I think the dissatisfying answer, at least if you're somebody who's schooled in economics like Governor Cook and many of the other people in this room, is that there isn't like a single cause of this industry sort of emerging almost out of nowhere in the 2010s. Instead, there are several reasons why we got private credit. I really think of there being 3 main ones. The first is that coming out of the financial crisis, regulators all over the world, in the United States and Europe and elsewhere, were really interested in reducing the level of risk in the banking system. And this led to some level of retreat from lending by a number of especially mid-market banks or banks that serve the mid-markets, not necessarily mid-market banks, which then created a demand for credit that hadn't been there before because a lot of firms that might have needed to borrow 10, 15, 20 million dollars because the normal private credit loan is something about there. They needed a new capital source. Right, so there was kind of demand for capital that was created by post-financial crisis regulation. The second is that the types of asset managers that raise capital from big foundations and investment funds to then put to work doing kind of private capital things needed a new investment strategy because the traditional leverage buyout strategy was tougher. It was getting tougher to earn money, tougher to find good buying opportunities. Like the whole thing was challenging, and a lot of those big asset managers began to develop this alternative, which is instead of borrowing money to buy companies, we can make loans. Steve Schwartzman, the CEO of Blackstone, was quoted as saying something to the effect of like, why would you bother with private equity if you can just lend money and get a senior secured loan at 15% interest? Like, who wouldn't just do that forever? And so there's a logic to this. I mean, you can't do that forever most likely, but there's a logic. And then the third thing is that as asset managers gathered larger and larger pools of capital, they found first that this investment strategy allowed them to earn more returns the more money they raised because they could make more loans, and they could say they were diversified by making lots of loans to lots of borrowers across sectors. And then they also developed a product that borrowers found to be very useful. It was useful in plugging the capital hole created by post-crisis regulation. It was also useful because they could go in and borrow money extremely quickly with certainty of execution. And these lenders, like private credit asset managers, as compared to banks with complicated credit committees and investment committees and things like that, they're pretty user-friendly. And so people liked working with it, and they're willing to pay a premium for it. So it all kind of works great, which is how we ended up with about $2 trillion currently being managed by asset managers who aim to make senior secured loans at about a 40% LTV, and that's what they do.
Very straightforward, the
Yeah.
way you explained it.
Yeah, it's good.
Tarek, can you pick up the ball at this point and let us know how it looks from your perspective?
Sure. So I have a handful of slides, but I'm not really a slide guy anyway, so if they don't go up, it's fine. The biggest thing to focus on in terms of why are we talking about this now is, the asset class grew really, really fast. It quadrupled in size to about $2 trillion in a decade and a half. But the real focus, I think, is just the retail footprint. So if you look at what's actually in private credit, it's about $600 billion of BDCs, both listed and unlisted combined. So your footprint in retail is about 30%. It took the high yield bond market about 45 years to get to that same retail footprint. The syndicated leveraged loan market, which is probably the best analog to private credit, it's about 10% retail. So that's a really interesting fact, and frankly, it's a really big part of why we're talking about it. The other thing that really is driving the focus, and Governor Cook touched on this, is the software exposure. So to put just some numbers around that, largely because of when private credit came to be, the software exposure of the private credit asset class is about 20%. For comparison's sake, leveraged loans are about 14%. Again, that also grew a lot in the last decade, which is why it's a pretty big component of private credit or of software. High yield bonds, for comparison, are under 5% software. So the older asset class, the one that's been stable in size, just doesn't have the software exposure. And so in an AI world, that potential for dislocation drives a lot of attention. And so when you think about what is this going to look like, kind of post, hey, look, we got slides. On a go forward, it reminds me a lot of CLOs post GFC. So pre-GFC, two guys in a Bloomberg could start a CLO business and be pretty successful. Post GFC, you needed an institution. You needed portfolio management, trading, risk managers, research analysts, back office, the whole 9 yards. So that meant that there was consolidation, and while you could start a new entrant, it was usually very high pedigree. Private credit right now, or really call it 2 years ago, you needed a senior person, whether that was a banker or a very senior investor with a big Rolodex, and they could have a private credit business really fast. On a go forward, again, you're probably going to need a lot more in terms of infrastructure, analysts, risk management, et cetera, and it's going to be harder. And again, probably see consolidation and the big get bigger. So one last thing I wanted to leave you with before I turn it over is, and Governor Cook touched on this, but AI for anybody who's in credit markets day to day and the data center build out is basically our entire life in 2026. It's been much more important, frankly, than the conflict in Iran in terms of how the market is traded, how the market's behaved. For context, hyperscalers have done over $100 billion of investment-grade bonds in the last 6 months. So investment-grade data center builders and owners have done almost $50 billion of bonds in the last 6 months. And in the high yield market, data center companies have done about $40 billion of bonds in the last 6 months. High yield data centers went from 0% of the high yield market to 2.7% in 6 months. And as someone who grew up in the shale bubble, housing bubble, et cetera, I've never seen anything like it. And we're still early stages, and it's going to accelerate, not slow down. Hand that over to them. Thanks.
You want to pass the...
Thank you.
Okay, Nina, let's hear from you.
Great, thank you. So today I'm going to focus on a bigger picture view of credit provided by banks and non-banks. As always, the views are my own and not necessarily the views of the Federal Reserve Bank of New York or of the Federal Reserve System. So since the global financial crisis, as banks have retrenched, as we heard from some lending to the non-financial sector, both academics and policymakers have been wondering whether non-banks or NBFIs amplify or stabilize credit cycles. This chart is essentially plotting the 3-year growth in bank credit versus non-bank credit for a large set of countries across many years. And as you can see, the large credit booms, which I have highlighted in blue, can be financed by either banks, non-banks, or a combination of the two. So meaning that non-banks can also be a source of the large credit cycles that the academic literature has argued have damaging effects on future economic growth. The other point that I want to make is that while banks and non-banks are a useful distinction as a starting point, in reality, banks, non-banks, and the real sector are highly interconnected, as you can see from this network of financial claims in the US as of the end of 2025. In our work, when we take into account these indirect claims, we actually find that banks are still a large end provider of credit in the US economy, so that this network of intra-financial claims actually intermediates a large volume of credit for the US. Finally, if we look at specifically some of the providers of private credit, debt claims on the left-hand side, equity claims on the right-hand side, we see that banks and insurance companies in particular are large lenders to the sector. And so from that perspective, private credit may pose a financial stability concern, with losses to private credit providers potentially propagating through this network of claims to the more traditional financial lenders and potentially impairing credit provision overall. I'll stop there.
Thanks, Nina. So let's do some follow-up here based on these remarks. I'm going to ask a few questions, and then again, I encourage you to start thinking about some questions that you want to pose to our panelists. So I'm going to start, I'm going to go in the order that we spoke. So Jared, let's suppose, based on the commentary in the room, for sake of discussion at least, that we are maybe heading into a stress cycle. Eventually we will, perhaps, where we see significant Chapter 11 filings of firms that tap the private credit market. So how do those insolvency processes play out as distinct from the insolvency processes of traditional, from firms that got their credit from traditional public markets? And will the bankruptcy system be able to cope with that type of insolvency if it comes in a spate of failures?
Okay, so I wrote a paper about private credit, not that one, that's actually a different Elias, which is funny. I guess we're all interested in private credit. But when I was doing that, I tried to have conversations with people in private credit and background research to learn more about what they thought would happen when things went badly. And I heard from them things like, well, our strategy for distress is we only make good loans. And so obviously that is not in the long term a strategy that's going to work. And so there are already some isolated examples of some major restructuring, some inside of court, inside a traditional Chapter 11 process, some happening through other state court procedures that allow investors to exit a position, like an assignment for the benefit of creditors or a state court receivership and things like that. But private credit is not a generalizable phenomenon in distress, right? So you can't say, well, private credit's going to change the world that we know for the following single sentence reason. And that's because private credit lenders have moved into spaces, some of which used to be inhabited by traditional banks or groups of banks that would provide middle market loans. And they've also moved into that bigger ticket, sponsor-backed large loan area. And right, in both of those, they're taking the space of different types of institutions that were there before them. So in those middle market cases, private credit lenders are just more sophisticated and more willing to take risks than traditional mid-market serving banks are. Private credit lenders are much more willing to put people on boards of directors, for example, when things go badly. They're much more willing to exercise board flip rights and to take control of companies, to take the keys to companies, and to just get rid of the existing shareholders. Traditionally, banks don't love doing these things and they try to avoid doing these things. Private credit lenders are also they have a lot of control over when they mark their paper and how they mark it, and the ability to choose to an extent when they realize losses. I mean, not totally under their control, but they have quite a bit of control. I heard a story recently of a private credit lender that decided they didn't want to take a loss, so they would just pick a loan. And so that meant that instead of taking a $60 million loss a couple years ago, they took an $140 million loss, afterwards, and none of that delta between the $60 million and $140 million was real. It was all just picked debt. So
just for the benefit of everyone here, payment in kind, you want to just give a quick...
Yeah, payment in kind. So a lot of private credit loans have picked toggles, or just because private credit lenders have the ability to renegotiate very quickly, there's no need to coordinate a lender vote, since private credit lenders tend to hold the loan on their own. They can agree to the borrower that instead of you giving me $1 million in cash interest this quarter, we'll add that to the tab and you'll owe me another $1 million. And so by doing that, you can blow out the amount that private credit lenders are owed very quickly, even though nobody thinks that those promises are real. It's just a question of when the lender chooses to realize the loss. Relatedly, there's a new friction in debt markets, which is, sort of fund life cycles. So private credit lenders may behave differently when the funds that they're using is towards the end of its life, or when they're engaged in fundraising than they might during other periods. And sort of a last point, because that has already been a long answer, is for the cases that used to have broadly syndicated loans as the main creditor of, let's say, a sponsor-backed firm, private credit doesn't trade for the most part. So that means that the traditional Chapter 11 model since the mid-2000s has been the judge could assume that whoever values owning this company the highest has bought into the part of the debt stack where they'll get to own it in Chapter 11. But that's not going to be true anymore because you won't have that trading of the debt in many cases. You still could somehow, but it's not liquid. You're not having the same level of research analysts following it because there's not trading to stimulate through providing research. And it just means that bankruptcy judges are going to probably have to do more to create liquidity in assets than they're used to doing. Bankruptcy judges right now routinely agree to have auctions on like 30-day timeframes, and you may need longer when the asset is something the market doesn't know as much about because none of the capital structure was traded. So there's all kinds of interesting things to come.
So one thing I would add to that is that really over the last 10 years, the proportion of restructurings that have happened in court versus out of court has changed pretty dramatically, with out of court really being the focus. And again, we don't know this because we haven't really seen a default cycle in private credit, but given some of the frictions that Jared's touched on, our expectation internally is that out of court is going to be the path of choice as you work through distressed private credit situations.
It occurs to me as I listen to you guys that something like that might explain the fact that private credit is more expensive for firms of the same credit rating. But on the other hand, it could be an apples and oranges comparison where you have different borrowers going to private credit markets than those that are going to public debt markets. Do you see an explanation coming out of these higher distress costs, or is it coming from selection of the borrowers into each respective type of market?
There's been so much convergence in the last few years between really the leveraged loan market and the private credit market in terms of loans that are being originated, and there's been substitution and cannibalization between those two. So I think it's less about what borrowers are accessing the market and much more about just illiquidity premiums at the end of the day. You have to earn something more to earn something that's liquid.
Because of the liquidity effects that you guys both discussed.
Yeah.
Let me follow up with you, Tarek, because I listening to your remarks, I had a question that probes deeper into the area that you and Governor Cook spoke about, which is the impact of AI on private credit. I'm guessing that the majority of the people in the room have been reading in the financial press about the impact of AI and software as a service, and from that, and the amount of private credit loans that have been made to software firms, that there's going to be an impact. So can you go a little deeper on that? What's the impact from a default perspective? Is that likely to lead to, are we looking at the leading edge of a default cycle because of that? And given all that, what does that imply for the incentives of the borrowers and lenders in private credit when they're exposed to these kinds of risks?
So I'm going to put my paper down because this is a long answer. So I think it's important to remember that if you look across the credit continuum, we've been in a really low default rate environment for 3.5 years straight. So the long-term average default rate in high yield is about 3%. It's about 3.2% in leveraged loans. There really isn't one in private credit because we haven't had a real default cycle yet. But LTM, we're 200 basis points of defaults in high yield and leveraged loans right now. So relatively low numbers. We do expect that to go up, still to kind of below long-term average levels in the high yield market. In the leveraged loan market, we expect that to go up to about 4.5% in 2027. Which still isn't that bad in the scheme of things, but it is higher. It's higher by a lot, just from a low base. And a little bit higher than that, candidly, for the private credit market. We have kind of 5% penciled in for 27. The big driver of that is that software exposure, right? So, for leveraged loans, you've, again, 14% software, private credit 20%. We don't think, and I don't think anybody expects, every software company to go bankrupt. That's a terrible assumption. But there are companies that maybe don't have, a vertical integration or horizontal integration moat, don't have some sort of data moat, and those companies probably will be exposed to dislocation. In terms of time frame, there's a big maturity wall in 2028. And in software in general, both in leveraged loans and private credit.
Is a wall of debt coming due then?
Yeah, so a lot of maturities in 2028. When you think about that, it's really the year before that it all gets dealt with. So end of this year, 2027, there's going to be a pretty big wave of refinancings and liability management exercises, which are, can be both painful or benign. Now, what's interesting here in terms of incentives is we actually think it's probably going to be one of the more benign liability management waves, purely as a function as you have a very weird alignment of interests right now between asset owners and lenders, which is basically none of us know what software company actually works long term yet. And so because of that, if I'm a lender, it may be that, if your company maybe isn't the best software company, you as a sponsor might have another company to integrate it with. You might have an interesting plan in terms of creating some sort of moat over the next 2 or 3 years that I, as a lender, even if I'm a huge lender, don't have. I don't have that optionality. So my advantage, my incentive right now is to keep the asset in your hands to figure out this problem. It helps a lot that this is a very unique situation, because normally when you have this kind of industry interruption, dislocation, interruption, we don't know about it until it's already hit. Here, it's like we know this is potentially coming, but these companies are actually making a ton of money, they're generating a ton of cash. So as long as you're investing that cash back into the business and or figuring out a way to prevent us both from having a big problem in a couple of years, I just want to keep the asset in your hands. I'll probably put some more covenants on it. I'll probably force you to, again, reinvest, reduce your distributions to the equity, et cetera. But we kind of want to work together on this.
Let me flip that on its head. We've been talking about software as a service getting hit by AI, but the amount of debt in the AI market has been skyrocketing as well. And there are different takes on that. Some of it is, well, it's all internal. It's only a few firms. Is there, if AI doesn't pan out the way it seems to be, is there a lot of debt and is it affecting both public and private markets? It seems to be mostly private debt. And is that an issue?
As you sit here today, if you add up hyperscaler debt plus data center debt and corporate credit markets, it's about $450 billion. There's another $50 billion sitting in structured product markets. In a weird way, it is somewhat circular in that every data center has a lease from a hyperscaler at the end of the day. So, you're looking towards a hyperscaler credit rating. The bigger challenge is that, if we're going to build out more of 100 gigawatts of data centers, and it's an absurd number, right? Like that's 10 New York Cities worth of power over the next 5 years. It's going to cost $5 trillion. We're probably going to finance about $3 trillion of that. So that footprint is going to go up really, really quickly. The portion of that that's actually private right now is modest, and really it's GPU financings so far have generally been done in the private markets in terms of as private credit. But if you sort of max out investment grade bond capacity, max out high yield bond capacity, max out structured products market capacity, there's still a call for like $1 trillion over 5 years from alternative markets. That's going to be infrastructure funds, government, et cetera, but also a little bit of private credit. So yes, if AI does not work down the road, private credit will have a big issue along with every credit market.
Maybe along with the whole economy, because
and
we've all been depending on AI to make the economy.
I don't want to hijack this, but when you think about bubbles, right? Normally, when you have a bubble, it's because there are no constraints on growth, right? Here, the constraints on power, water, infrastructure are so massive that building all of this in the timeframes discussed is going to be super hard, and so it's going to take a lot longer to play out than I think we all expect. I mean, the first bubble calls on AI were in 2023, prior to the 100+% move in markets.
Yeah. Thanks. I'm going to come back to Nina now. You're in the Federal Reserve System, so I'm going to ask you a question about financial regulation. So coming out of the global financial crisis of 2008 and 9, regulators and Congress got religion on making banks much more resistant to failure. Higher capital requirements, higher liquidity requirements, a lot more regulation in general. And many have said that that's significantly responsible for the creation of the private credit market and the migration of credit provision outside of the banking system. So you might say, well, as Jared discussed, it's longer-term lenders into private credit. They're not flighty. On the other hand, it's less well regulated. What's your take? Has this worked out as hoped, or are there any trapdoors that we might not have thought about when designing those regulations?
Right. So I think it is exactly that trade-off between spreading out some of the necessary credit provision that has to happen in the real economy away from banks and into other parts of the financial sector, and the question of how much regulatory authority and how opaque those other parts of the financial system are. So if we think more broadly, and not moving beyond private credit into a lot of the other type of financial services that have moved out of banks into, let's say, hedge funds, I think the question is very much still out there. So during COVID-19, for example, we saw that a lot of the trading activity that has moved out of banks into hedge funds very much had negative implications for financial stability during periods of stress. And I think to a large extent, the biggest hurdle there is the fact that some of these less regulated parts of the financial system are at the same time a lot more opaque. So it's hard even from an overall financial stability assessment to actually know what are the risks being taken in those parts of the financial stability system. If we think about private credit specifically, I think we have all seen the wide range of numbers that people think about how much private credit there is out there. So that's even just from a direct measurement perspective, let alone when we start thinking about the types of interconnections between private credit lenders and the more traditional parts of the financial system that I was talking about in my remarks.
So you're sanguine or concerned?
I'm a financial stability economist. I'm never allowed to be sanguine.
I see. That's wise. It never pays to say there's not going to be a crisis.
Yes.
Okay, so there's a lot of expertise in the audience. I'd love to see some hands, and since in the interest of time, rather than a longer speech, how about just a brief comment or a question, especially questions for our panel. Don't be shy. And we have microphones, I believe. Ann Cassells is right here.
I could probably do without a microphone.
They want to record it.
Yeah. Without a microphone. Hi, Ann Cassells. Private credit has had issues about whether or not we can trust the values that are put on it. Does this create any kind of systemic risks?
That's an open-ended question. Tarek?
So we do a lot of work on marks, particularly with the BDCs all report their marks, and you can cross-reference them. And in general, the variance on average is about 300 basis points on where it's marked. So one person might have it marked to 95, the other person has it marked to 92. What is interesting is the other half of my institution finances a lot of private credit. So private credit assets, and we have remarking rights ourselves. So we don't use them that often, but we have rights to remark assets when we want to. We remarked assets during COVID. We remarked assets during 22 in the big interest rate move. And we did remark some assets in the first quarter of 2026. The moves, the amounts that we remarked were not huge. And that's, from our standpoint. So I don't think of it as systemic, because I also don't think of the funding structure for private credit assets as having an enormous amount of systemic risk, but it's definitely something worth watching. In particular, we talk about PIK. We try to differentiate PIK into this good PIK and bad PIK construct. So if you look at the market, there's about 12% of private credit loans PIK today. About 200 basis points of those PIK when the underlying loan is marked below 90, which seems like a really bad idea. And so that's something that we watch very, very carefully. That 90, somewhat arbitrary, but that is a general definition for distress that has been used for years.
So just to clarify, when you said you don't see it to be that systemic, does that mean because the size of the market is not that big, or because the extent of slow marking is not that problematic?
I think the underlying asset class, and Governor Cook touched on it, while banks do finance a portion of it, a lot of that BDC market is financed in wholesale markets, not bank markets. And so because of that, there isn't a huge transmission mechanism that we see. And we hope that we're right. We're bond analysts and strategists, not stability economists.
We can ask. And there's a question at the very back. Yes, just next to the camera. Thank you.
Hi, Jeanette Garrity. Thank you. Very interesting topic, obviously interesting comments. Forgive me a bit of a devil's advocate question. I think it's directed at Jared, but anybody can jump in. You made the comment that private credit can just do things so much better than a bank senior credit committee. It can move faster, a number of things. I know those committees very well. If bank senior credit committees didn't have the regulation that they have, didn't have the mark-to-market requirements that they had, didn't have the investors that they have effectively, would they be able to do the same thing?
So, I think if you ask the private credit people, and we don't have any on this stage, so I should be careful, but I think they would say, no, we're smarter than them anyway. I don't want to go too far. It's not a question necessarily of better. I think that it's a better experience for some of the companies that go to borrow in this market, because they feel like it just moves very quickly. And, if a CFO decides they want a loan, they'd rather get it today than wait 6 weeks or wait months to clear a syndication process. But yes, if you were to similarly deconstrain the financial industry, presumably they could move with similar velocity. But whether or not that turns out to be better from kind of a holistic underwriting perspective, that's an open question that we just don't know about. So to return a little bit to the previous question, is the mark autonomy point, is it systemic risk? That I'm not sure about. I don't really think so, for the same reason Tarek said. However, does it create questions about how much these things are worth? Sure. So until we really make it through a full cycle, it's not really clear. Are they better at underwriting or not? But they certainly do it quickly. At least that's what people experience.
I see Fred Grauer's hand up in the back of the room.
Could you describe a little bit the transparency of the private credit market, the quality of the data? There are some views that the quality is not great, and the comprehensiveness of it is not complete. The consequence would be we're looking at the private credit market through a glass darkly, and will not see crisis evolving as quickly as we ought to.
So as somebody who's worked very closely with that data, so the part of the data that's publicly available is what you can see on BDC disclosures filed with the Securities and Exchange Commission. And there you can often see a loan was made to Jared Inc. for, on this date, for $100 at this interest rate, and we currently market at 98 cents on the dollar, something like that. So what you can't learn from that is what is the underlying business of Jared Inc., right? Often those businesses are not huge brand name companies. They're a single website. If you go looking for them, it's hard to know very much about them. So that part of the market, the BDC part, you can see some things, but we don't know if that part is representative of the broader whole. Like, it probably isn't. And even there, what you can see, given the degrees of freedom with marking things and also the questions about what these underlying businesses are, it's interesting. So in some ways, this, I think, was part of the secret sauce of private credit, this kind of fuzziness and opaqueness. And in some ways, that suddenly turned from a feature into a bug, where private credit asset managers are now anxious to show the world their bona fides and their credit worthiness, and they don't really have the right disclosure mechanisms to do so. They can't just hold up the audited financial statements of all of their borrowers. So there is information out there, but it's hard to know what to take from it for for all of these reasons.
Fred, just to follow up on that, and agreeing with Jared, the BDCs have a lot of transparency because they're public companies. And the only research that I'm aware of in financial economics that studies the data is based on BDCs for that reason. So if it's not among BDCs, then we have much less knowledge about exactly what's going on.
Every time you extend a loan, you sign an NDA, right? So, we have a decent amount of data that we sort of look at on an aggregated, no names basis across sectors. It's not great, but what it looks like is it looks a lot like the syndicated leveraged loan market at this point in terms of if you look at like leverage levels, coverage levels, et cetera.
And in the insurance company space, you definitely see some of these effects because, of course, for insurance companies, they need to have ratings on the assets that they hold. And so one of the things that we have seen is on the private credit CLOs is a lot of credit rating dispersion across rating agencies. Again, kind of highlighting the opaqueness of this market overall.
Yes, the gentleman at this table on my left, yeah.
Thank you. Very interesting. As you all know, I'm sure, private equity funds have suffered a pretty substantial drawback this year as a result of some of the private credit stuff that you guys have chatted about. And Jared mentioned earlier, and the previous question kind of touched upon some of the opaque data structures. I'm curious, what indicators would you pay attention to from kind of our standpoint, our vantage point, in distinguishing between different private equity firms, the private credit kind of systems and structures, I guess, that they have, or investments that they've made to kind of pass through the data and make sense of what's going on in that area of the private credit space.
So just to make sure I understand, you're interested in differentiation across the private credit space and indicators that might help us understand that differentiation.
Yeah, and where problems might lie.
Yeah. Any reactions, anybody?
I mean, I think what you'd see from a lot of asset managers in the last few months has been a lot more disclosure on their exposures to technology, their exposures to software. I think both Apollo and Blackstone, I think, publicly hired external consultants to go through and say what's in their portfolios, just as an example. And so I think for now, that's probably, the biggest thing to look at is the sector exposure.
So that's on the asset side. What about on the funding side? Is there variation in terms of maturity, picking sources of funds?
Every fund finances a little bit differently, but if you look at a standard BDC, they start off financing with bank funding and then they term it out into the unsecured bond market. That mechanism got disrupted a little bit back in February and March, and then you saw Blue Owl, which is one of the sort of headline BDCs because of their technology focus, do a number of private one-off bond deals with a large West Coast asset manager to prove that, look, we can get funding whenever we want it in the wholesale market.
Yeah, that was good signaling. Is there another question? If there's not a question, I want to follow up on this issue of bank funding. So at least around the lunch table over in our finance group, questions we ask are, to what extent are banks indirectly exposed? Nina addressed the fact that the risk has moved out of the banking sector into the private credit market, but not 100%. There is bank funding. Jared or Nina or Tarek, any idea of the extent of bank funding of private credit and the form that it takes in terms of maturity and seniority?
The extent I don't know, because again, it's also kind of hard to know who exactly or the size of the market. I think in terms of, and also banks don't necessarily need to be lending directly to private credit lenders to actually be exposed. So again, if you think about the ecosystem between banks, insurance companies, and private credit lenders, insurance companies might be the ones who wind up holding the securitized version of a private credit loan.
With a lot of seniority, or?
Yes, because for insurance companies to make this trade economical, they want to be holding the highest rated
Economic
tranche.
for capital regulation.
Yes.
Yeah.
Yeah. But then the insurance companies will be getting funding from banks to actually finance their balance sheet, not necessarily directly for that specific asset, but overall as an exposure. So, which again goes back to the idea that there are a lot of interconnections in the modern financial system, and it's a little hard to untangle where the credit ends up in.
But no red flags. Yeah. Not going to get that answer from Nina. We have a question at this first table right here.
Thank you, Pamela Holly Family Office. On a question on the data center build-outs and with the amount of credit that it's taking this year, what is the kind of forecast of how long that is going to take? We seem to focus on 2026, but are these loans for that data center build-out continue to be needed 2027, 2028? How long do we think that's going to happen? And second, what kind of hiccup could happen here? Data center defaults. If the data center is working with Google, then Google comes in and saves it. If they're not, what does that look like?
Yeah, so over the next 5 years, again, we think there's about $3 trillion of debt issuance/borrowing to pay for data centers and GPUs and the whole 9 yards. And if you think about that, that actually goes up in 28 and 29 relative to the 26 level because of the pace of construction. So I said it sort of in my opening remarks, but it's probably going to be the thing that we talk about the most in credit markets. After the private credit market is through its cycle and back and running again, just because it's just so much paper. We don't know, so there's uncertainty around what does a default look like for any of these assets. What we can say is, barring some massive change in technology beyond what we can foresee, we're so short compute globally that the demand for the underlying assets is really, really high. And so when we take our comfort, and a lot of these high-yield companies building data centers are, repurposed Bitcoin miners, right? But we take comfort in the fact that compute is so incredibly short, and every one of these sites is a competitive process, not just in terms of the data center builder pitching the hyperscaler, but multiple hyperscalers coming to the same data center builder asking for the same site. So compute is just short, so that helps.
Good perspective. I'm sure there are more questions, but I'm afraid that we've run through the end of our allowed time. So I want to thank Tarek, Jared, and Nina for really, really enlightening remarks. Thank you